job losses, housing price dips, a stock market roller coaster. What if I told you that in between all this chaos, there are some golden opportunities? Financial institutions, including the Bank of America, forecast significant job losses, with over 160,000 per month in the United States alone. While specific real estate markets may weather the storm differently, Wall Street anticipates a nationwide housing price decline of 7%, with a potential plunge of 15%. But amidst the turmoil, there are several opportunities for wealth creation. 8. Have access to cash. Well, you will need cash, as being liquid will play a huge role. Although inflation has painted cash as an enemy, the current predicament the market is about to face could be an opportunity for a potential increase in value. Cash is no longer considered invaluable, contrary to popular opinion, and this has historical backing. Holding on to cash gives you something to fall back on in case there is an issue. In 2008, cash outperformed the market, and in 2023, most prominent fund managers have the highest amount of cash dating back to 2001, which recognizes its importance as a necessary lifesaver. The true opportunity in cash lies not only in the defensive power, but also in its offensive power, especially during an economic downturn. Number 7, reduce spending. Several strategies are important to survive the storm and grow financially during recession periods, but 2 main strategies are just as important. First, it would be a wise decision to cut down on unnecessary spending and live below one's means. To effectively do this, a contingency plan that could reduce spending by about 30% could be implemented. Strategic cash reserves would also be another great option. Opportunities for investment should not be ignored, but having a portion of assets in readily accessible cash would provide flexibility and give a strong opportunity for potential buying when the chance arises. 6. Long-term investment. Not cashing out from long-term investments might seem like a terrible idea when navigating economic downturns, but in the long term, it would be a smart move. Panic and impulsive selling in the financial market is something that affects investors during bearish trends, and this is usually due to fears of missing out and financial turmoil. However, according to historical data, the market is remarkably resilient. From the Great Depression to other conflicts, the stock market has gone through several storms, but patient investors who stayed till the end have always reaped the benefits. This might give off the idea that one should never withdraw profit, no matter the trend of the market, which is why it is advisable that you have adequate knowledge about an investment before investing in it. Several areas require rapt attention when considering the potential markets in 2024. As global financial markets navigate to turbulent waters, an analysis of the current turndown, which has a significant impact on all 3 major indexes, the Dow Jones Industrial Average, the S&P 500, and the NASDAQ Composite, which have experienced a dip exceeding 20%, would be necessary. Companies like JP Morgan have anticipated the possibility of a steeper depreciation, which could reach 20% below the current levels. Although there is a possibility of a further decline in the market, having adequate knowledge of historical benchmarks and recognizing capitulation, which is a potential turning point, would be necessary to make wise investment decisions during a period of economic uncertainty. It is nearly impossible to predict the future the same way it is nearly impossible to predict the timing of the market. Instead of making investment decisions out of fear, the long-term trajectory of investments should be focused on. Number 5, freelancing. During economic downturns, traditional job markets usually get tighter and the freelance markets get looser. Monetizing skills online, which could be in writing, web development, or graphic design, would be an excellent decision. This goes without saying that one should invest adequately in oneself to be good enough for the freelance market, because the competition would definitely increase during an economic crisis, which the example of the COVID-19 pandemic can mark. 4. Invest in precious metals. During periods of economic crisis, precious metals like gold and silver retain their value, especially when other investments struggle. Having actual silver items or gold items in your inventory would be a good investment, and the reason is the scarcity of some of these materials. For example, gold is scarce, and the effort required to mine is tremendous. This sets it apart from economic situations, and it is not affected by the ups and downs of economies. The rich see investing in precious metals as a way to secure their money, and these metals are recognized globally and do not depend on the single economic situation of a country, which makes them an excellent investment, no matter the location. 3. Recession is an opportunity. In a scenario where there is a 20% discount on the price of everything, some might see it as a negative thing, but investors would see that as a positive. This same principle applies to stocks. Falling prices should be seen as a chance to acquire assets at a discount. Recession periods also force companies to buckle up, which allow agile players to step in. A recently conducted study across over 15,000 companies revealed that during the recession era, the value of brands was significantly boosted, and it also gave an opportunity for post-recession growth. Several popular companies were founded during the recession periods. An example would be Netflix. Founded in 1997 by Reed Hastings, the platform was launched while the Asian financial crisis was unfolding. It began as a DVD rental service and became the leading streaming platform, redefining entertainment consumption. Hewlett-Packard, established during the Great Depression in 1939 by Bill Hewlett and Dave Packard, started in a one-car garage and blossomed into a global leader in information technology. In a declining economic climate, rather than seeing a cause for alarm, strategic investors would see this as an opportunity by recognizing the reduced competition and creating their own springboard for wealth creation. 2. Buy the dip. Carefully navigating a bear market with the proper strategies can also lead to significant long-term profits. It is common knowledge that recessions are usually indicators of bull markets. During recessionary periods, the S&P 500 average decline has been about 29%, with a median drop of 24%. However, declines like this are usually followed by considerable spikes. The following year, the average returns rose by up to 40%, and within 2 years, the market recovered an average of 58%. Although it might seem like the best option is to invest at the peak of a recession, it can be extremely difficult to identify the bottom point during recession periods. Recessions are mostly confirmed with a considerable lag of between half a year to a year after unofficial confirmation. 1. Invest in real estate. In the near future, several financial institutions like the Bank of America have predicted a quantifiable number of job losses, which could reach over 160,000 job losses per month in the United States alone. Although variations across different regions are a huge factor in real estate, and certain markets might not be severely affected, the price decline of housing nationwide has not been frequent. Over the past 6 decades, data reveals just a few occasions where there was a more than 10% drop in real estate prices. Despite this, there is a contrary picture of the economic climate currently. Wall Street anticipated a national housing price decline of 7%, and the potential decline to reach 15% has been considered. Different markets will be impacted uniquely by the fluctuations in the real estate market. Locations like Southern California and Arizona have a potential of experiencing a drawdown of about 25% from the peak, and this could last about 5 to 12 months before stabilizing. In a broader context, homeowners with fixed-rate mortgages who plan to hold out for a few years might not be affected significantly by this. For investors and potential buyers, this could be an opportunity for a market entry, as there would be more attractive deals to take on. If there is a new development, trust that you will be the first to find out on this channel. So, don't forget to subscribe so that you do not miss out on anything. Feel free to drop your comments below, share your thoughts, and let us know what topics you'd like us to explore next. Thanks for watching.